Okay, so you're also going to learn about fixed and flexible budgets. Fixed budgets are also sometimes called static budgets, and they are essentially based on a single level of activity. Okay, a flexible budget, also sometimes called a variable budget, is where we can create a budget that adapts to our production level. Okay, so it can be based on more than one activity level because, as we know, some of our costs are going to vary depending on the level of production. So flexible budget gives us a little bit more flexibility in comparing our actual results against what we've planned. So a flexible budget can be prepared before the period begins and is often based on several levels of activity. So budgets for different levels of activity provide somewhat of a what-if analysis that often includes our best case and worst case scenarios in terms of activity levels. So this can allow management to make adjustments to help improve profitability for the period. A flexible budget prepared after the period ends can help evaluate performance. It's somewhat of an apples to apples comparison because budgeted activity level can equal the actual activity level. And the comparison of actual results with budgeted performance at the same activity level are more likely to reveal the real causes of any variances. Managers can then focus attention on the problems resulting in unfavorable variances and some opportunities resulting from the favorable variances. Okay. Standard costs can be used in a flexible budgeting system to enable management to better understand the reasons for variances. Standard costs are essentially preset costs for delivering a product or service under normal conditions. We can think of standard cost as budgeting on a per unit basis. We expect to operate within the standard cost allowances under normal conditions. Production managers and engineers often determine the production requirements for 1 unit of product, and accountants put those requirements into dollars. Now, when actual costs vary from standard cost, management follows up to identify potential problems and take corrective actions. Management by exception means that managers focus attention on the most significant differences between actual cost and standard cost and often give less attention to areas where performance is reasonably close to the standard. Management by exception can be especially useful when directed at controllable items, allowing upper management to affect the actions of lower level managers who are responsible for the company's daily operations and revenues and cost. So budgets are used in preparing standard cost. Standard cost can also help control non-manufacturing costs. Companies providing services instead of products can benefit from the use of standard cost. For example, while quality medical service is important, efficiency in providing that service is also important to control the cost. So the use of budgeting and standard costing could be effective in that setting, especially when it comes to overhead. So the difference between actual cost and standard cost is called a standard cost variance. Cost variances can be either favorable or unfavorable. If our actual costs are less than standard cost, then the variance is favorable because that's a good thing. If our actual costs are more than the standard cost, that variance is unfavorable because that's a bad thing. Now, simply, a cost variance is calculated as the actual cost minus the standard cost. The cost variance can then be further broken down by the components. Actual quantity, often abbreviated AQ, is the actual amount of direct material, direct labor used to manufacture the actual quantity of output. Standard quantity, often abbreviated SQ, is the standard input expected for the actual quantity of output. AP is the actual price paid to acquire the materials. SP is the standard price that we had planned to pay for the materials or the labor. So price variances occur when we pay an actual price that's different from the standard price that we should have paid, and quantity variances happen when we use a different amount of the resource than what we had planned on using. Okay, so here we see this broken down between the price variance and the quantity variance for direct materials and direct labor. And once we identify our actual quantity, actual price, standard quantity, and standard price, we are ready to plug those amounts into these formulas and compute each of the variances accordingly. Okay. And here you see the expanded formula for our overhead variances. Now, sometimes the overhead variances can seem a little bit more complicated, but just remember, refer back to your formulas, and once you plug in the appropriate items into your formulas, you should be able to calculate the variable overhead variance as well as the fixed overhead variance. So I hope that this brief lecture has helped, and I hope that you feel more prepared to dive into this week's material. If you encounter any questions at all, please always feel free to reach out to me. Have a great week.